A desperate move as President Biden taps the Strategic Petroleum Reserves. I'm your host, Steven Van Metre, and thanks for joining me today. And with inflation running out of control and becoming a political issue, President Biden unleashed the Strategic Petroleum Reserves in a historically unprecedented way. It's going to have huge effects on the economy and the markets. Let's head over to Bloomberg, who headlines with Biden sets $1 million a day oil release to tame prices, and OPEC Plus, co-led by Moscow, balks at ramping up production. Let's continue because the U.S. released roughly 1 million barrels of oil a day from its reserves for 6 months, beginning in May, a historic drawdown underscoring the White House concern about rising gas prices and supply shortages following Russia's invasion of Ukraine. The White House said the release from the Strategic Petroleum Reserve was unprecedented. This record release will provide a historic amount of supply to serve as a bridge until the end of the year when domestic production ramps up. And that is merely an understatement. This has never been done before. Of course, we've had presidents unleash the Strategic Petroleum Reserves, but never, ever at a level this high. Of course, as we understand, inflation is a huge problem eating into American pocketbooks and threatening to send the economy back into a recession, which no president will want. Let's continue on. Because pump prices are weighing heavily on the White House's political prospects in November when voters will decide. Again, I've mentioned this before. This is a wildly big political issue. If you bring inflation down, potentially stay in office. High inflation, good chance you or your party is headed out. Voters will decide on whether Biden's party will retain control of Congress. The president struggled to tame both gasoline prices and broader inflation, neither of which are the job of a president, which is at a 40-year high as the global economy adjusts from pandemic disruptions. And here you can see in a chart of crude oil prices, West Texas Intermediate and U.S. regular all formulations gas prices, they're in sync. And it makes perfect sense when you understand this because a barrel of WTI, well, it's a barrel of gasoline, and that's why those prices are in sync. Bring prices of oil back down? Well, guess what's going to happen to gas prices? You've got it. And the administration will also push the International Energy Agency to coordinate releases from reserves by other oil-consuming nations. The organization will meet within days, two people familiar with the matter said, and the administration expects the other countries will make some reserve releases, but nowhere near as much as the U.S. But the releases won't be accompanied by greater production from OPEC Plus nations. After the cartel said Thursday it'll stick to gradual increases. OPEC Plus, which includes Russia, ratified an existing plan to increase supply in May by 432,000 barrels a day in an online meeting, according to a statement. But that's not going to be enough. And, everyone's going to look at this and say 1 million barrels a day. But is that really actually going to do the trick? Well, not so much. But even that would not be sufficient to make up for the loss of Russian crude, as many traders steer clear of sanctions and logistics of picking up cargoes near a war zone. According to the International Energy Agency, Russian output could drop by 3 million barrels a day in April, and that means additional supply from the United States would only replace a third of the lost production. And here's what they're going to try to do. We've looked at this chart before. If you dump the Strategic Petroleum Reserves into the economy, and what you are going to do is fill up Cushing inventory levels. And here we can go back to 2014, mid-2018, and here now where you see near record low levels at 2022 of inventories at Cushing, Oklahoma. And what will happen? Well, we've seen this before. In mid-2014, you had high oil prices. As Cushing inventories went up, prices went down. And here you see in mid-2018, prices come down as inventories go up. And what does that mean again here in 2022? It's going to be the same story. They're going to try to drive up inventory levels. And of course, as WTI goes down, well, that means gas prices go down with it. But we're going to make a huge sacrifice as a nation. And I want you to see this next chart. And this is the Department of Energy Strategic Petroleum Reserve in red, and projections this by zero hedge of where the Strategic Petroleum Reserves are going to go. And they're going to go down significantly. And the hope is it'll bring oil prices, here you see in green, way down with it. But the sacrifice we're making as a country is massively significant. And I want you to understand that during the pandemic, we borrowed a ton of money and bailed out consumers and businesses. Now, I'm not saying we shouldn't have done that. And absolutely, we needed to do that for humanitarian issues. But where did that put us? Headed into another recession potentially. It left us with no ability as a country to go out and borrow more money to boost the economy out of recession. Now we're going to drain the Strategic Petroleum Reserves. So if there is any other incident that needs lower oil prices, we will be tapped out. And how about monetary policy? What did the Fed do? Is massive amounts of QE and zero interest rate policy that they're barely trying to crawl out of. And it leaves us no latitude from borrowing, no latitude from the oil markets, and no latitude from monetary policy should we fall into another recession. And if we do, there's one thing that shouldn't be going down with it, and that's your portfolio. If you haven't checked it out, be sure to check out Portfolio Shield. I'll put a link up here in the corner in the description below. You'll be glad you did, because inflation is a huge, huge issue here. As we can see today's headline from the Wall Street Journal, the U.S. inflation rises to a 40-year peak in February by Fed's preferred measure. The Commerce Department said on Thursday that its personal consumption expenditures price index climbed 6.4% in February from a year ago, faster than the 6% increase for the year that ended in January. The February rise was the fastest since 1982. And the so-called core, I don't know why it says so-called, core PCE, which includes volatile food and energy costs, rose 5.4% in February from a year before, compared with a 5.2% increase for the year through January. That marks the sharpest 12-month rise since 1983. And if there is any hope, we're going to look at now at a chart of crude oil prices on a year-over-year rate of change against the consumer price index on a year-over-year rate of change, and you can see they have a very nice relationship. It's not a close relationship, but now as you move here into the post-Great Financial Crisis, you get a bigger link between energy prices and inflation. And we've seen the year-over-year rate of change of crude oil prices are coming down here, and I've drawn the red arrow that will likely head lower, suggesting that indeed the consumer price index is headed lower. And as we're facing a curve inversion, well, is this going to have an impact on the bond market? Absolutely. And as we know, many people have bailed on the bond market. As bond prices have gone down, and interest rates gone up, investors have just left in droves, holding one of the smallest allocation in bonds in perhaps the history of the market. And today, we get what is very bond bullish news. And check this out. Here is a chart of crude oil prices, WTI, against 30-year Treasury yields. We'll go back to 2014. Mid-2014, of course, we see Cushing inventory levels rise, and that leads to lower Treasury yields. How about here in 2018? Again, we see Cushing inventory levels at low levels and then head higher, and then yields go down. And now, thanks to the Strategic Petroleum Reserve release, well, what can we expect for oil prices to do? Well, we expect them to go down. And what does that mean for Treasury yields? Well, that means they're headed down too. And so what I believe is a major mistake is going on here is truly a desperate move to contain inflation to keep the economy from falling into recession. But the chances now that if we fall into one, well, we have absolutely no ammunition left. No fiscal, no monetary, and no crude oil. It's going to leave us in a dangerous situation when the next big one hits. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.